Hey, what's up guys? Welcome back to our channel and I hope you're all doing well. In this video, I'm going to give you an update on Canada's raging housing market, where the market is potentially headed, and should you be expecting a crash anytime soon. There is so much to talk about. Let's jump right in. Interesting news coming out of TD Economics. According to them, Canada's housing sales have begun their correction. And as far as the TD Bank economist is concerned, the interesting question will be how steep the decline will be. And I'm sure if you're watching this video, you have the exact same question. How low will the housing market go? Now, I want to make an important distinction here. What's correcting are sales, not prices. The theory is that once sales start correcting, prices should soon follow. And what's been happening in the market is that as prices have gone and exploded, prices have skyrocketed, so too have the amount of down payment you need to buy a home. Saving for a down payment is still a goalpost that keeps moving further and further away. If you're looking for a home in Canada's top cities, you will need to save for at least 25 years just to save 20% down based on an average income. Just think about that for a minute. You need to save 25 years just to save 20% down. And by the time you actually end up saving for that 20% down, house prices will likely have gone so much further ahead. So we're in this vicious cycle. The cycle is that the more you need to save, the higher the prices go. You're constantly chasing something that's moving much faster than your ability to actually save. Because not only are you trying to save for a down payment, you also have to face rising cost of living. So whether you're getting squeezed to saving for a down payment, or you're getting squeezed saving for more and more expenses, this is an impossible situation and it's incredibly unsustainable. Because the fact is, if you don't have existing equity, you're chasing something that's running much faster than you are if you're saving for a down payment from scratch. Let's take a deeper look at the actual stats. In the city of Vancouver, you need to save 34 years just for a 20% down, where the average cost of a home today is close to $1.5 million. In the city of Victoria, you need to save 28 years for a 20% down, where the average cost of a home is just over $1 million. In Toronto, you're looking at saving 26.5 years for that 20% down, where the average cost is $1.2 million. And in Hamilton, Ontario, you still have to save for an average of 6.5 years for a 20% down, where the average price there is just under $900,000. Now, if you're looking to save between 3 and 4 years for a 20% down payment, your target cities are then Ottawa, Montreal, Calgary, where the average cost of a home is between $445,000 to $671,000. And if you want to save for 3 years or less for a 20% down, then your choices are Edmonton, Winnipeg, or Quebec City, where the average cost of a home is still under $500,000, where you're looking at a range between $330,000 to $429,000. Having looked at these stats, there may be some silver lining. Some economists are actually saying that the crazy run-up in Canada's housing prices has already peaked, and it's all downhill from here. March seems to be the absolute peak of the mountain in terms of the activity. Canada's home sales have dropped nearly 25% since March. Sounds a lot, right? But considering the insane spike we've seen in just the first quarter, sales are still remarkably strong even considering this decline. The fact that the pandemic made the housing market even more unsustainable, there are a few factors that could contribute to how fast it falls. And later in the video, I'll talk about, is the Canadian housing market, is it headed for a crash? But before we actually get to that, there's an important piece of information that you need to know that impacts the cash inflows into the housing market, and this has a major impact on pricing. The hard fact that makes the Canadian housing market so much more competitive is that if you're a buyer, you're not just competing with other normal buyers, you're also competing with corporate buyers. Between 2008 and 2019, at least $20 billion of housing purchases were made from corporate buyers with no checks or balances to determine the actual owners of these corporate purchases. And these purchases from the corporate buyers tend to be all in cash deals. So how do you, an average buyer, even compete with that? I know of individuals out there who have used these corporate entities to make all in cash home purchases in the GTA and the GVA. This is an important reality. You may be competing with corporate buyers. To me, this is crazy. At least 50,000 homes were purchased in the last few years with corporate money, with no actual trace of where that money actually came from. How is this even possible? You might be wondering. Well, it's possible because of a concept known as beneficial ownership. Beneficial ownership is the person or entity that actually benefits from a corporation. Canada, much like any other tax haven, doesn't actually keep track of beneficial owners. Instead, The government only collects a list of directors and just a mailing address. This is great from a privacy standpoint, but at the same time, it can also be problematic in some cases, like the times when these corporate buyers are buying homes in a limited supply housing market. Corporations buying homes in the GTA with all in cash deals has been increasing every year since 2008. Corporate ownership isn't a problem per se, it's the lack of information on buyers. The vast majority of these corporations buying these homes may be totally legitimate businesses or not, but we have no way of knowing. Supply is already limited in the Canadian housing market, and having corporate buyers with a treasure chest of cash buying these homes makes things so much more complicated, especially for buyers trying to get into the housing market. Even a few $1 billion of laundered cash into the housing market can have a massive impact on destabilizing prices. While there's still a lot of activity in many of the housing markets across Canada, things have noticeably calmed down in the last few months. Now, are these the first signs of a potential housing market crash? There remains a shortage of supply of housing in many parts of the country, but at least the competition in some of those housing markets has cooled down a little bit. That level of competition has gone down in the last few months. To me, the real issue with the current housing market situation isn't so much the risk of an unstable bubble and then a crash, but rather the increased pressure this has placed on individuals with limited means, even with average means, to purchase a reasonably priced home. There is so much pressure on individuals today just to find a reasonable place to live, whether it's renting or buying. Sure, we have a mortgage stress test to avoid people getting in over their heads, but this does very little in terms of helping individuals find affordable housing in the first place. Now, on the other side, people have been installing backyard pools, purchasing watercrafts, RVs, and other fancy gadgets and toys, all on credit. And all this purchasing that's being done on credit is something to pay close attention to, as interest rates will start to rise as early as 2022. This credit market will be something to pay close attention to as these interest rates start to inevitably rise. Now, here's where things get interesting when you're talking about a potential housing market crash. Banks like RBC base their national housing price projections on certain macroeconomic factors, such as unemployment, consumer spending, and economic growth. If Canada were to see economic turbulence, a massive rise in unemployment rates, and a prolonged recession instead of a recovery, we could potentially see a nuclear winter in terms of the housing market. So what does this nuclear winter actually mean? In the housing market nuclear winter forecast that RBC has laid out, an average home in Canada that costed over $700,000 in March of 2021 would be valued at just over $500,000 by June of 2022. That's close to a 30% price drop. And this would be a major gut punch to any recent buyer who made a home purchase during the absolute peak. Even new owners who put 20% equity down on a recent purchase find themselves short on equity. And if they felt pressure to sell after a major price collapse, they would have to do it at a loss. Now, this scenario is the absolute worst possible scenario based on RBC's forecast. Major point being, this is just a scenario. If points A, B, and C happen, then we may see a nuclear winter for the housing market. However, looking at the way the vaccination rates are going and the uptick in the economy that we're seeing because of the reopening, it's likely that the current housing market will stay hot, just not super hot. So we may not actually get a Canadian housing market crash so long as the economy is able to hold its own. Now, with home values going deeper and deeper into uncharted territory because of this unstoppable growth, there are a few factors that may keep this momentum going. One is immigration. The Canadian government is on track to welcoming 400,000 newcomers into the country just this year alone. And the year after that is another 400,000 newcomers in each of those years. That's a total of 1.2 million newcomers into the country in 2021, 2022, and 2023. That's 1.2 million people that will place additional pressure on the housing market as new potential buyers. The point is that people expecting the housing market to crash and burn shouldn't hold their breath. There may be a correction, if anything, but that's just a small decline. You have major forces working against a housing market crash. High household savings rate, rising income levels, and a strong population growth are all factors that will just maintain this momentum and likely will keep sales above their pre-pandemic levels. Now, what's interesting is that in BC, prices actually peaked in March and have since come down a little bit since then. The second factor against the housing market crash are low mortgage rates. As the economy continues recovering, mortgage rates will eventually rise. With many lenders still offering variable rates below 2%, Canadians no doubt will still be tempted to buy or upgrade. The third factor, unsustainable demand. Even with the new stress test in place, the fact is that there are just more buyers than there are properties available for sale. This is just the cold, hard truth. Every time a home receives 15 competing bids, that just means that there will still be 14 buyers looking for the next one. When you look at all the factors I presented in this video, factors that may lead to a crash, factors that may lead to continued housing price growth, let me know in the comments, which factors do you believe will be the major drivers on where this housing market goes next? If some unforeseen calamity were to take place, one, that slaughters the income levels of both homeowners and renters, you might see some sellers desperately racing to get out of their mortgages. Until then, the real worst case scenario that Canadian home buyers have to actually watch out for is actually RBC's best case scenario, one where most properties in this country cost well over $1 million. The fact is that the pandemic has had obvious economic ramifications that has affected many people in this country. While many people face negative consequences due to the pandemic, there are groups of individuals out there who had a positive impact from the pandemic, and one where they were able to keep or upgrade their jobs and increase their income levels at the same time. The reality is that the pandemic led to an increase in the wealth gap in this country. Individuals who face positive financial circumstances, coupled with low mortgage rates, allowed them to either upgrade their existing property or just purchase new ones. In Ontario, many people want to live in and around the GTA. This is another major factor that contributes to the rise in real estate prices in those areas. If there are too many people chasing too few homes, then prices will rise. This is a classic case of supply and demand doing its thing. The supply side needs to be addressed. The problem is too much attention gets put on the demand side. Thank you so much for watching. This channel would not exist without your love and your support. If you've enjoyed this video or any one of my other videos, consider hitting that super thanks button on the bottom of this video. It's a new way to directly support your favorite content creators on YouTube. Or if you'd like, you can buy me a virtual coffee as another way to support my content and the channel. All proceeds will be used to bring you even more value-added content that I hope will leave a lasting impact on your investing journey. If that sounds good to you, check out the link in the description of this video to buy me that virtual coffee. And on that very same page, you can download my custom-built Excel-based dividend portfolio tracking spreadsheet, which I use to track my own dividends, forecast my dividend income, and track my gains. So you can keep track of your portfolio exactly the same way I do. If you have questions for me, feedback on this video, or maybe you have ideas on future content, let me know your thoughts in the comment section. And while you're at it, make sure you've hit that like and subscribe button or that thanks button. That's it for now. I'll talk to you in the comment section.